Recall from our previous videos that we've been looking at calculating realized gains or losses as the difference between the amount realized and the adjusted basis. Here, from the seller's perspective, the amount realized is a sum of any cash received, plus fair market value of other property received, plus the disposition of liabilities, minus selling expenses. The adjusted basis was defined as the original cost basis, minus accumulated cost recovery deductions like accumulated depreciation, plus capital additions. In the simplest terms, the realized gain is the difference between the value of what the taxpayer got and the adjusted basis of what the taxpayer gave up. In this video, we'll look more closely at what makes up the calculation in the adjusted basis. In particular, we'll look more closely at the original basis of the property. Importantly, how does this basis get here? Well, the original basis depends on how the property was originally acquired. The first major and probably most common way to acquire property is to simply purchase or buy the property. So if the property is acquired through a purchase, the taxpayer will simply use the cost basis of the property. For example, if I'm selling land to someone and I originally bought the land for $100,000, then the basis I'll use to calculate whether or not I have a gain or loss will be that $100,000. That is the cost of the land to me upon my original acquisition of the land. There are a couple of extensions here I'd like to discuss. If the property was purchased through what is known as a bargain purchase, then the basis equals the fair market value of the property at the time of the purchase, and not what the purchaser originally paid for the property. This difference between the cost paid for the property and its fair market value actually gets included in the basis. That is, the basis is adjusted upward from the price paid up to the fair market value. And this upward adjustment will actually be included in the buyer's gross income and get taxed. The reason this happens is because once a taxpayer pays tax on his income, it establishes basis. And that in the future, when the property is sold, the taxpayer will use the higher adjusted basis that reflects the fair market value and not the lower adjusted basis that reflects the price paid for the property. An example here might be useful. Let's say an employee purchased land from her employer through a bargain purchase agreement for $20,000. But the fair market of the land was $30,000 at the time of the purchase. What happens here is the employee recognizes that $10,000 difference between the price paid and the fair market value in income, essentially as compensation, and pays tax on it. This recognition of income allows the land's basis to be adjusted upwards to $30,000. So if in the future, let's say the land is sold by the employee for $100,000, the gain will be $70,000, or $100,000 minus the $30,000 adjusted basis, and not the $100,000 minus the $20,000 price paid. Now, if multiple assets were acquired in a lump sum purchase, that is, one purchase price for more than one asset, the taxpayer has to allocate the total cost of the purchase to the individual assets based on the individual asset's fair market value. Here, the purchase price is assigned to the assets, excluding goodwill, to the extent of their fair market value. Goodwill represents any excess amount paid for the assets above the total fair market value of those assets. If the taxpayer pays more than the total fair market value of the assets, then goodwill becomes its own asset. In fact, it's an intangible asset and is amortized as such. We do not allocate or spread the value of goodwill across the other individual assets that we purchased. That is, goodwill does not increase each asset's basis based on how much the taxpayer overpaid for each asset. Let's look at an example of how a lump sum purchase works. Here we have Sheila, who runs a business that rents apartments to tenants. She sells 3 of her buildings to Natalie, an unrelated party, for a total of $1 million. Natalie is a savvy buyer and negotiated a very favorable deal. The appraisals show the following fair market values. Building 1 is worth $400,000, Building 2 is worth $800,000, and Building 3 is worth $200,000 for a total fair market value of $1,400,000. What is Natalie's basis in each building she purchased from Sheila? Again, Natalie only paid $1 million for these 3 buildings. Well, first, let's set up a table here where we look at each building separately. Here we confirm that the total fair market value is $1.4 million. Now what we need to figure out is how much of the $1.4 million does each building represent in terms of relative fair market value. To do that, we divide the individual fair market value of each building by the $1.4 million total fair market value. So for building 1, we divide $400,000 by $1.4 million. For building 2, we divide $800,000 by $1.4 million. And for building 3, we divide $200,000 by $1.4 million. What we get are the percentages based on the relative fair market values of each building. So building 1 represents 28.6% of the total fair market value in this lump sum purchase. Building 2 represents 57.1% of the total fair market value, and building 3 represents 14.3% of the total fair market value in this lump sum purchase. So we take these percentages and allocate them to the total purchase price in this lump sum purchase. In particular, the sales price was $1 million. So we take the percent of total fair market value for each building and multiply it by $1 million to obtain the basis in each building. So for building 1, we multiplied 28.6% by the $1 million to get a basis of $286,000. For building 2, we multiply 57.1% by the $1 million to get a basis of $571,000. And for building 3, we multiply 14.3% by the $1 million to get a basis of $143,000. You add them up, and you should get the total basis of $1 million, which equals the price paid. So here, because Natalie paid less for the buildings than their total fair market value, she needs to allocate that purchase price across each building based on each building's relative fair market value to the total fair market value. Now let's change one fact. And let's say that Natalie bought the 3 buildings for $1.5 million, not $1 million. And the 3 buildings represented Sheila's entire business. What happens here? How would you treat the goodwill? So what happens here is that Natalie paid $1.5 million for buildings with a total fair market value of $1.4 million. In effect, Natalie overpaid for the buildings. Maybe she did that because she thinks the buildings will be even more valuable in the future. So how does she figure out her basis in each building? Does she allocate the price based on the relative fair market value percentages? Well, in this case, because the purchase price was greater than the total fair market value of the assets, she will not need to allocate the purchase price to each asset the way we did in the previous example, where Natalie paid less than the total fair market value. Here, Natalie will simply use the fair market value of each building as her new basis in each building. And any excess amount she paid, that is the goodwill, will become its own asset. It's actually quite straightforward in this case. This is how it looks. This is the fair market value of each building, as we know from the fact pattern. Again, the total fair market value totals to $1.4 million. Because the purchase price of $1.5 million was more than the total fair market value of $1.4 million, the fair market value of each building simply becomes the basis in each building. Therefore, the basis in building 1 is simply $400,000. The basis in building 2 is $800,000, and the basis in building 3 is $200,000. What happens to that excess $100,000 that was paid, or the difference between the $1.5 million paid and the $1.4 million total fair market value? Here, the $100,000 becomes its own asset called goodwill. It is an intangible asset that is amortized over 180 months straight line, as we saw in a previous video. We do not allocate that $100,000 according to the relative fair market values of each building. We can't do that because buildings are depreciated as tangible realty using the mid-month convention, and goodwill is an intangible asset. So if we were to basically spread the basis of the goodwill across the 3 buildings, we would be mixing apples and oranges. That is, mixing up the different types of assets. We can't do that here. Here, to the extent there is goodwill, it becomes its own asset. In summary, we're starting to look more closely at adjusted basis. In this video, we looked more closely at the cost basis, or the basis that is established when a taxpayer purchases property. We looked at a bargain purchase situation and a lump sum purchase situation. In the lump sum purchase situation, if the price paid is less than the total fair market value of the asset purchased, then the taxpayer has to allocate the purchase price across the assets based on their relative fair market values. However, if in a lump sum purchase, the purchase price is greater than the total fair market value of the assets purchased, then the taxpayer's basis in the new assets simply equals the fair market value in each asset, with the remaining excess amount paid, or the goodwill, becoming its own asset.